Okay, welcome to problem 4-8B. This is a gargantuan problem. I think the technical term is honkin' big problem. So feel free to skip around to look at the parts you need and to skip past the parts you don't need, and to use this as a tool to help you be successful on the problem if you need it. You don't have to watch the whole thing through. It's probably going to take 30 minutes to an hour depending on everything. All right, so I'm just going to get started here. This is a company name I can't pronounce, opened by this company, we'll call it George, even though there's no R. Cleaners on March 1st, 2014. During the March, the following transactions were completed. It gives us a list of all these transactions. Then it gives us a chart of accounts, tell us what other accounts. And then the first thing it tells us to do is to journalize the March transactions. So we'll do that. So on March 1st, we have issued 10,000 shares of common stock for 15,000 in cash. All right, so sorry, I had an interruption there. March 1st, issued 10,000 shares of common stock for 15,000 cash. So I'm not going to do a lot of explaining. I'm just going to go through it. Cash account, 15,000, and common stock account, 15,000. Whoops, not 1,500, 15,000. These little pound signs are what Excel's way of telling you the number is too big for the column. So you just have to expand the column a little bit. On March 1st, they purchased a used truck for $8,000, paying $3,000 in cash and the balance on account. So we're going to show the asset equipment. That's how they're going to track their truck. Increases by $8,000, the total cost. The asset accounts payable is 5,000. That's going, I'm sorry, that's not an asset. I lied to you. The liability accounts payable is increasing by 5,000, and the asset cash is decreasing by 3,000. On March 3rd, purchase cleaning supplies for $2,000 on account. So our supplies asset will increase by $2,000, and our accounts payable liability will increase by 2,000. On March 5th, paid $2,400 cash on a 6-month insurance policy effective March 1st. So our prepaid insurance, that's an asset, will increase by $2,400, and our cash asset will decrease by $2,400. March 14th, billed customers $3,700 for cleaning services. So if we're billing them, that means that we've earned the money, but they haven't paid us yet. So our accounts receivable, that's an asset that represents money owed to us. That will increase by $3,700. And our revenue, I think they call theirs service revenue, will increase by $3,700. March 18th, paid $1,500 cash on amount owed on the truck and $500 on amount owed on cleaning supplies. So we'll show our accounts payable going down. Remember, that's a liability, so it decreases with a debit by 2,000. And our cash going down by 2,000. On March 20th, paid $1,750 cash for employee salaries. So we'll have salaries and wage expense increasing by $1,750, and our cash decreasing by $1,750. 21st, collected $1,600 cash from customers billed on March 14th. So our cash will increase, and our accounts receivable will decrease by $1,600. meaning it's no longer owed to us because we've collected it. March 28th, billed customers $4,200 for cleaning services, so accounts receivable. Increased by $4,200, and our service revenue. March 31st, paid $350 for gas and oil used in truck during the month. Used maintenance and repairs expense. Well, that's nice. They told us which expense. Maintenance and repair expense. $350. And our cash goes down by $350. And then March 31st, declared and paid a $900 cash dividend. So we're going to have dividends. Our cash goes down. So there's our journal entries. I know I went through those quick, but you can rewind it and watch it again if you need to. Let me shrink it so we can fit them all on one page, although that might make it hard for you to see them. There's our journal entries. So that was part one of the problem. Part two is to post to ledger accounts, use T accounts. So I am not going to make you sit through me setting up all the T accounts. I will set them all up on another tab, and then I'll make you sit through me filling them out. All right, through the magic of time-lapse photography, you didn't have to watch me set up all of these T accounts. So, just count yourself lucky. Anyway, so the second thing we're doing is posting to a ledger account. So that would be all the journal entries we've done over here. We're going to post to the T accounts or the ledgers here. So I'm going to go ahead and make this full screen because we don't need to see their data right now. And I'm going to make it a little bigger so it's easier for you to see. And again, I don't think I'm going to make you watch this whole thing. And certainly if this is something that's easy for you, you can just fast forward through it. But in essence, what we have to do every time is we need to go back to our journal entries and enter them. The nice thing is there's no beginning balances on this business because it's a new business, right? It started with the contribution of the owners, so everything has a beginning balance of 0. So on March 1st, we debited cash $15,000 and credited common stock $15,000. So March 1st, we debited cash $15,000 and we credited the common stock account $15,000. And we go through and we follow that process for each entry. On March 1st, we debited equipment $8,000, we credited accounts payable $5,000, and we credited cash $3,000. So we'll come over and we'll find equipment. March 1st, $8,000. Accounts payable, $5,000. And it was cash, I believe, was the other $3,000. I'll do about 5 of these, and then I'll pause it and do the rest of them. On March 3rd, supplies, we debited $2,000, and accounts payable, we credited $2,000. So March 3rd, supplies, was it 3,000 or 2,000? 2,000, sorry about that. And accounts payable. On March 5th, prepaid insurance was debited $2,400 and cash was credited $2,400. March 5th. And cash. And on March 14th, accounts receivable debited $3,700, service revenue credited $3,700. So accounts receivable. and service revenue is credited. All right, so I'm going to go ahead and just pause the recording and I'll finish moving all of these over. I think you get the point of how to do this. I hope so. And then I will come back once it's all filled out. All right, so there we have, we've ledgerized, that's not really a word, but we've ledgerized all of our journal entries. And I didn't find balances yet because we're going to do more with them going forward in the problem. But I could figure out the balances from there. All right, so let's look at the next part of the problem. All right, so prepare a trial balance at March 31st. Oh, I guess we do need to find the balances to do a trial balance. So again, I'll kind of walk you through that process. We add up both sides, and then we subtract the smaller side from the larger side. So in the case of cash, we've got, I'm going to just do a balance here right now. And that balance is going to equal the debit side, whoops, not equal, sorry. Minus, oh, Excel doesn't like it. Minus the credit side. So we're going to come up with a balance of 6,200. And then I'm going to do that for each of these. So for accounts receivable, the balance as of this date is going to equal my debit side minus my credit side. Supplies balance, prepaid insurance, equipment. Accounts payable, since that's a liability, we'll do the balance on the credit side. So this will equal the credits minus the debits. And service revenue will have a balance. And we should say that's the balance as of March 31st before any adjustments, right? Okay. So there's my balances. So that's all the information I'll need to now create a trial balance. I'm going to go ahead and make that full screen again. And so the trial balance, let me add a sheet, will have all of these accounts in it. So we have to look, and we're just going to do them in this order: cash, accounts receivable, supplies, right down the order that we did the ledgers in. So let me just fill that out. I'm going to say GEOG, cleaners, trial balance, and March 31st, 2014. Let me make that a little bigger so it's easier for you to see. And I'm just typing in all the accounts. And I'll pause it so you don't have to watch me type all this in. You get the point. Where I'm getting them from is each of these accounts that we've done the ledgers on. All right, so there's all the accounts, and then I will put in the debits and the credits. So cash had a $6,200 balance. Whoops. Accounts receivable had a $6,300 balance. Again, I'm getting that information from these P accounts where we figured out the balance for each one. Supplies has 2,000. Prepaid insurance, 2,400. Equipment, 8,000. Accounts payable, 5,000. Whoops. Salaries and wages payable. Actually didn't have any, so we can take that line out. Dividends, a debit balance of 900. Yeah, I'm missing some. Oh, I'm missing common stock. Common stock had a balance of 15,000. Dividends 900. Service revenue 7,900. Maintenance and repair expense is 350, and I forgot salary and wage expense. Which was 1,750. That should be everything. You can double check here. Each account that had a balance should show up on my trial balance. And then we'll total them up and hopefully they balance. Sorry, I got the decimals all weird here. 27,900. And 27,900. So there's our trial balance. All we do to create a trial balance is we take the balance of each of our ledgers and we kind of put them all together. That's it. All right. So that was number 3, prepare the trial balance. Now it says journalize the following adjustments. So I'm going to go back to my journal here and I'll just add the adjustments. I'll put a little line that says adjusting entries. And then we'll do them down here. All right, so the first one is services performed but unbilled at March 31st was 200. So if the services were performed and unbilled at March 31st, then we have to record them because we've performed them, we've earned the revenue. So March 31st, we have accounts receivable, 200, and service revenue of 200. Depreciation on equipment for the month was 250. So nice, they just give it to us. Depreciation expense, 250. And accumulated depreciation, on the equipment was 250. 1/6 of the insurance expired. So we have to go back and look at our balance of our insurance account. Prepaid insurance was 2,400. So 1/6 of that was used up. Remember, it was a 6-month policy. So 1/6 of 2,400, or 2,400 divided by 6, is 400. Which means we incurred the insurance expense, and we're going to reduce the asset, prepaid insurance. All right. An inventory count shows $280 of cleaning supplies on hand at March 31st. So remember, we had 2,000 worth. Now we have 280 worth. That means we must have used up whatever that comes out to, 2,000 minus 280, right? Which means we must have used $1,720 worth of cleaning supplies. So supplies expense 1720, which is the 2,000 that we had minus the 280 that are left, means we use 1720. And we're going to reduce the asset supplies. And finally, accrued but unpaid employee salaries were 1,080. That means the employees have earned the salaries, but we have not yet recorded them, so they are accrued. So we're going to do salaries and wage expense. We've incurred the expense of 1,080, and salaries, wages payable, 1,080. So there's our adjusting entries. Now it's probably going to tell us to post the adjusting entries into the T accounts. Okay, so we'll go back to our T accounts, and I'll enter each of these. Accounts receivable debit 200 on March 31st. So I'm actually going to get rid of this balance. All right, accounts receivable debit 200. And service revenue credit 200. We'll have to figure out new balances after we enter all of these, but right now I'm just trying to do it quickly here. All right. Depreciation expense 250, accumulated depreciation of 250. So depreciation expense, which was right here, 250. And accumulated depreciation, which should be over here with the assets, and we had insurance expense of 400, debit and prepaid insurance credit of 400. So insurance expense and prepaid insurance, the asset, it's credited 400. Supplies expense debited 1720, supplies credited 1720. So supplies expense and supplies are credited. And then the last one was salaries and wage expense of 1,080 and salaries and wages payable of 1,080. And the payable, salaries and wages payable. Something's not sitting right with me on this one. Let me go back and look at my previous transactions. That should be salaries and wages expense, not salaries and wages payable. So there's something that happens to you the more accounting you do. Where are we at? Salaries and wages. There it is. And I call it that you get a good sniff checker. And what I mean by that is, you know how when you open a carton of milk and you know something ain't right, and it just kind of smells wrong. Well, that happens with accounting. The more you do it, the more. So I saw that 1750 on the debit side of a payable and thought something's not right there, and was able to go check it. That's a really nice just tool, I guess, that kind of comes to you as you do it more and more. Anyway, so I have that fixed. All right, so there's all of my adjusting entries have now been put into the ledger, and now I can do adjusted balances. That's probably the next thing it's going to tell me to do. Let's see. Prepared adjusting entries, post the adjusting entries into the T accounts, and then prepare an adjusted trial balance. So in order to do that, we'll have to have new balances on all of our accounts here. So I also just wanted to make sure that my mistake I made on the salaries and wages payable. I didn't carry it over here. I think I did. I did it right, even though I made a mistake, so we're okay. All right, so let's get new balances. So cash, we didn't do any adjustments to, so there'll be no new balance. The balance of accounts receivable will be our debit side minus our credit side. Balance of supplies will be our debit side minus our credit side. Balance in prepaid insurance, same thing, debit minus credit. Equipment, accumulated depreciation, that's still the same, no adjustment. Those are that's all good. Our service revenue will now have an $8,100 balance. And all right, so we have all of our new balances, and now we should be ready to do our adjusted trial balance. So I think the way I'm going to do that is I'm just going to come to this trial balance, and now I'm going to copy it, and I'm going to paste it down here. I'm going to call this new one the adjusted trial balance. And now I'll have to go back and move over the balances of each account again. So still $6,200 for cash. Accounts receivable is now $6,500. Supplies is now $280. Prepaid insurance is now $2,000. Equipment is still $8,000, but now we have an accumulated depreciation on equipment account. So I'm going to have to insert the balance of $250. Accounts payable has a $5,000 balance. That's still good. Common stock still $15,000. Salaries and wages payable $1,080. That one had a zero balance before, so we have to add it. Salaries and wages payable. And again, that is $1,080. Service revenue now has a balance of $8,100. Dividends didn't change. Maintenance and repair expense, $350. Supplies expense, or sorry, salary and wage expense, $28.30. And then we'll have to enter all the other expenses. We have depreciation expense, insurance expense, and supplies. And they had balances of depreciation $250. Whoa, it's doing that weird thing again. Insurance expense was $400. And supplies expense $1,720. That should be our adjusted trial balance. We will add them all up and make sure it balances. And if it doesn't, then we'll know we've got a problem. $29,430. All right, so we balance. So there's our adjusted trial balance. All right, so that was 6. We're getting there. Number 7, prepare the income statement and the retained earnings statement for March and the classified balance sheet at March 31st. All right, so this is pretty easy once we have the adjusted trial balance. In fact, I'm going to do it on the same page as the adjusted trial balance just to make our life easy. So to make an income statement, all I'm going to do, first let me copy this header information over. And we'll call it income statement. Remember, an income statement is for a period, so it's 1 through 31 March 2014. All right. So all we do to make that income statement is we copy all of our revenues and expenses over. And then we can, like I said, we can do a little bit of work to make it look nicer. Total expenses. We'll add up all the expenses. And then our net income, which will equal our revenue minus our expense. So it's that easy once you have especially if you're using Excel, once you have an adjusted trial balance, you can just pull the data right off of there, and it's pretty easy. Statement of retained earnings. So for that, we'll just say retained earnings at March 1st were 0, right? Because it's a new company. We'll add net income, which we just figured out is $25.50, less or deduct dividends, which we know that balance is $900. And that will give us our retained earnings at March 31st. So this will equal beginning retained earnings plus any net income minus any dividends. So there is our statement of retained earnings. Then the last thing we have to do is a balance sheet. Again, we have all the info already available to us. So let me just copy the header one more time. All right, we'll start with assets. I'm not sure if they want us to do it. They do. So we'll do current assets, which will be our cash, our accounts receivable, our prepaid insurance. That's our total current assets. Then we'll do a line that says total. There's our total current assets. Then we'll do our property, plant, and equipment. And that's going to include our equipment. And it's going to be less accumulated depreciation. Which we had right here. So that's not a sum, actually. That's going to be, this will equal the value of the equipment minus any accumulated depreciation. And then we'll have a line for total assets, which will equal our total current assets plus our total property, plant, and equipment. Then we have our liabilities. And that'll be broken into current liabilities, which will include our accounts payable, and our wages and salaries payable. I'll just move these over here. All right, and then that'll be our total current liabilities. We actually don't have any non-current liabilities, so our total current liability is going to equal our total liabilities. We can just leave it at that. And we'll do our stockholders' equity. And there we'll have common stock, which had a balance of $15,000. And retained earnings, which we had a balance from our statement of retained earnings of $1,650. So our total stockholders' equity and then we'll do our total of liabilities plus stockholders' equity. And that together should equal our assets. And it does, $22,730. All right, so we did an income statement, a statement of retained earnings, and a balance sheet. And really all we had to do is pull the information off of the adjusted trial balance, with the exception of the retained earnings, which we had to pull from the statement of retained earnings because we calculated it. Okay, so that is the end of that part of the process. I told you this was a big honking problem. All right, so that was number 7. Number 8 is to journalize and post closing entries and complete the closing process. Okay, so if you remember, the closing process is the process by which we take all the temporary accounts, which are the income statement accounts, and we return them back to 0 so that we can start a new month with 0 revenue, 0 expenses, and 0 dividends. Okay? And the process by which we do that is, well, I'll show you the journal entries. So we know that our temporary accounts will be the revenue and expense accounts. Why? Because the balance sheet accounts are permanent. They stay, okay? So we have dividends and then revenue and expense accounts. So if I want to make the balance of dividends 0 and it's got a debit balance of 900, then I have to do a credit entry of 900 to make it 0. So that's the process we're going to go through here. So if our service revenue account, let's see, it tells us to do journalize and post. Okay, so service revenue has a balance of 8,100 on the credit side, and I have to do a closing entry that will do service revenue, a debit of, what was it, 8,100? And then I've got to credit it to somewhere. So I use a special account that I only use for closing called income summary. And I credit that account 8,100. So that would be the closing entry for revenue. So if I were to bring it over here just so I can show you, on March 31st, we'll do 8,100 to service revenue on the debit side, and then 8,100 the income summary on the credit side. I've closed that out. So now the new balance of service revenue is 0, right? Because it had 8,100 on the debit side and 8,100 on the credit side. So the new balance is 0. And I have to do that for each of these temporary accounts. So I'm going to do one big entry here for all of my expense accounts. It's going to have income summary on the debit side, and it's going to have each of the expense accounts on the credit side. So we'll have salary and wage expense, insurance expense, supplies expense, all of those expenses. So I'll just go ahead and enter them. And then I'm going to, so I credited all those accounts, and then I'm going to debit the same amount to income summary, which is $5,550. So again, I'll bring them over here, and you'll see, so I do a $350 credit to maintenance and repair expense, and now that has a balance of 0. And I'll debit income summary the same amount. $1720 to supplies expense, I'll debit the same amount to income summary. Depreciation expense $250, debit the same amount to income summary. Insurance expense of $400, debit the same amount. And salary and wage expense of $2830, debit the same amount. All right, so now all of these temporary accounts, revenue, maintenance and repairs, the revenue and expenses all have balances of 0. But I do have a balance in this income summary account. And so I'm going to figure out that balance. Is $25.50. And if you think about this, this represents our net income, right? It would be the same thing as the net income we had on our income statement, $25.50. Why? Because it's our revenues less our expenses. So the income summary account, what we're left with is the same amount as our net income. And then what we're going to do is we're going to close out income summary because it's just a temporary account used just for closing. So if it has a balance of $25.50 on the debit side, we have to credit the, on the credit side, we have to debit the account $25.50 to make it 0, and we've got to credit it somewhere, and where we credit it is retained earnings. So the journal entry will look like this. And then when we put it in the ledger, you'll see that makes the new balance 0. And it closes that out to retained earnings. The last thing we have to do is close out dividends. Dividends closes out directly to retained earnings. So we'll do a debit here, or a credit here of $900, and then we'll debit retained earnings. And then our new balance in retained earnings is going to be the $25.50 minus the $900, $16.50. And that looks exactly like our statement of retained earnings, where we had 0 retained earnings to begin with. We added the net income of $25.50, we subtracted the dividends, and now we have a balance of $16.50. I forgot to do the journal entry for that. So retained earnings, dividends. Okay, so that was the closing entries, and now we have to prepare a post-closing trial balance. So let me go back to our trial balances here. So in essence, what we just did is we closed out all of the temporary accounts. So those are no longer going to show up on our trial balance. So what we're going to do is get rid of all of those accounts. That's going to be the revenue, the expenses, all gone, the dividends, all gone, and add the retained earnings, which has a balance of $16.50. Total these up, make sure we're in balance. And we're good. All right, that is the entire honking problem. Hopefully you were able to follow that as I went through it. So you'll see our journal entries now are broken into our regular transactions, our adjusting entries, and our closing entries. And then we did all of those on the T accounts. I could, for each of these accounts, I could put a balance of 0 at the end, if that would make it clearer. But I think you get the point. And then we have our trial balance. Sometimes it's called an unadjusted trial balance, our adjusted trial balance, and our post-closing trial balance. We have our income statement, our statement of retained earnings, and our balance sheet. And that's it. That took us 46 minutes. I told you 30 minutes to an hour, so I didn't lie. Have a great night, have a great week, and let me know if you need any help.